Let us be direct for a moment. Most of the financial advice you hear on CNBC, read in the Wall Street Journal, or discuss with friends at weekend barbecues functions like a carefully engineered sedative. It makes you feel as if you are participating in the grand game of the market. In reality, you are simply providing liquidity to the real players, those whom Richard Wyckoff called the composite man. This term refers to large institutions, smart money, and the entities that truly control capital flows. In this market, two entirely different rule sets exist. The public rule set, the one taught in classrooms, promoted by mass market financial advisors, and repeated on television programs, includes the following principles. Work hard. Save 10% of your salary each month. Diversify your investment portfolio and purchase a home as an asset. These principles sound safe. They are easy to follow. They create a sense of responsibility. However, they are designed to keep you positioned within the middle class for life, neither falling behind nor moving meaningfully ahead. The second rule set, which we may call the dark code in the spirit of Wyckoff, is exchanged only in quiet conversations behind closed boardroom doors in Omaha, New York, or Zurich. You will never see these ideas openly promoted in mainstream media. The reason is simple. They often contradict common intuition. They are uncomfortable. At times, they may even feel offensive to the listener. The mindset of the 1% who influence and control market movements is not merely superior. It is fundamentally different, like a separate operating system. While 99% of investors are busy trying to become smarter, chasing hot opportunities and seeking validation from the crowd, the 1% focus on eliminating foolish decisions with absolute discipline. They do not chase opportunity. They specialize in saying no. They do not seek social approval. They seek solitary truth extracted directly from the tape, meaning price action, and from trading volume. Today I will pull back the curtain. I will share with you 7 rules that major operators, the individuals and institutions who truly move and profit from the market, apply quietly in alignment with the Wyckoff method. These rules are not abstract theory. They are practical levers used when no one is watching. A warning from the beginning. What you are about to hear will directly contradict most mainstream investment advice you have encountered. It may lead you to think these operators are lazy or even ruthless. However, if you genuinely intend to transition from working for money to owning a system that deploys capital strategically, you must clear away the public rule set and install this dark code into your thinking framework. Welcome to the real game, where you are no longer a victim of the composite man, but begin learning how to read and participate alongside him. Prepare yourself. From here, we move into the 7 core rules. The first rule, and perhaps the most important mental model that investors who follow the Wyckoff method still apply today, is the religion of inversion, also known as the cult of inversion. This is not forward thinking in the way most people approach problems. Most American investors, from beginners to seasoned traders, tend to ask forward-looking questions. How do I become rich? What is the next Apple stock? How do I become an outstanding investor? These questions sound logical and ambitious. However, from both a mathematical and psychological perspective, they are exhausting and highly prone to serious error. You must constantly search, analyze, and predict. The harder you try to appear intelligent, the easier it becomes to fall into your own trap. Major operators, the participants who truly control capital flows in the way described by Richard Wyckoff, reverse the problem completely. They do not ask, how do I become rich? They ask, where could I end up financially ruined? What factors would certainly destroy my capital? Then they spend most of their lives systematically avoiding those dead zones. Charlie Munger expressed this idea in a well-known statement. He said, all I want to know is where I am going to die, so I will never go there. Many people laughed and assumed it was a joke. It was not. That idea forms the core foundation of capital preservation, the survival principle in every market, especially when you are facing the composite man. Consider a classic example that any American investor remembers clearly: the dot-com bubble at the end of the 1990s. The public and retail investors rushed to chase technology growth. They purchased internet stocks at extreme valuations with no profits and no real cash flow. They labeled cautious investors as dinosaurs, outdated, or incapable of understanding the new economy. The public rule at that time said, be smart, chase growth, identify the winning company. Under the inversion approach, aligned with Wyckoff, there was no need to identify the winner. It was only necessary to identify what would certainly destroy a business. no genuine cash flow, valuation far above intrinsic value, a business model that could not be clearly understood. When these three factors appeared everywhere during the dot-com bubble, disciplined operators chose to remain inactive. What happened next is well documented. Investors who chased returns of 100% or even 1,000% eventually fell to zero when the bubble burst in the year 2000. They were financially destroyed. Those who survived, even if they earned nothing during the euphoric phase, preserved their capital and continued compounding in the following decade. In the long-term game of the stock market, survival is the greatest victory. The mathematics of loss is unforgiving. This is a reality many investors ignore when they are overconfident in their ability to recover. If you lose 50% of your capital, you do not need a 50% gain to return to break even. You need a 100% gain. If you lose 90%, you need a 900% gain just to return to your starting point. Many people spend their entire lives digging out of holes they should never have entered. For this reason, the religion of inversion teaches three strict principles to avoid financial dead zones. Never use leverage. It is the fastest way for an intelligent person to go bankrupt, especially in highly volatile markets. Never invest in anything you do not clearly understand, even if neighbors or friends are making large profits from it. Never allow emotions to drive trading decisions. Fear, greed, and fear of missing out are primary enemies of accurate tape reading and sound judgment. This is the art of subtraction. Wealth is not created by adding more intelligence or constantly accumulating new information. Wealth is created by subtracting stupidity, by eliminating catastrophic mistakes that can erase an account overnight. The world is full of poor geniuses. Few people notice those who quietly avoid foolishness over long periods of time. The core lesson of the first rule is simple. Stop trying to be a genius. Instead, concentrate your energy on eliminating mistakes that could destroy you. If you accomplish only one thing, avoiding stupidity, long enough, you already possess a decisive advantage over 99% of other investors. That foundation prepares you for the next 6 rules, where the objective is not only survival but strategic offense in alignment with the composite man. The second rule. If the first rule teaches us how not to lose, this rule teaches us how to win big in the spirit that Richard Wyckoff described as playing alongside the composite man rather than against him. We call it the art of radical concentration. Most financial advisors, mainstream investment books, and television programs on CNBC repeat a sacred piece of advice. Do not put all your eggs in one basket. Diversify. Buy hundreds of stocks to reduce risk. It sounds prudent. It sounds responsible. It feels especially safe for the retail investor. Yet this is precisely why very few Americans become billionaires through the stock market. Excessive diversification is not the strategy of winners. It is a shield for those who do not truly understand what they are doing. Within the dark code, we follow the classic advice of Andrew Carnegie. Put all your eggs in one basket and then watch that basket like a hawk. Here is the uncomfortable truth that few people say openly. Diversification is protection against ignorance. If you do not understand a business, if you cannot interpret financial statements, if you do not grasp its business model and economic moat, then yes, diversify to avoid blowing up your account. But if you have conducted deep research, if you truly understand what you own, then spreading capital across dozens of positions you barely understand is a misuse of intelligence. Imagine you have Michael Jordan on your team, a genuine superstar. Would you trade him away in order to sign 10 average bench players simply to diversify the roster? That is the irrationality of excessive diversification. If you have identified 5 exceptional companies, firms with durable economic moats, strong cash flow, and outstanding management, why allocate capital to a 20th business you barely comprehend? That is not prudence. It is opportunity cost. Charlie Munger and Warren Buffett described a famous metaphor known as the punch card theory. They told university students to imagine that at the beginning of their career they receive a punch card with only 20 holes. Each hole represents one investment decision permitted for the entire lifetime. Every time you invest, you punch one hole. When all 20 holes are used, you are finished. If you truly lived by this rule, you would likely become extremely wealthy. The reason is simple. Each decision would be treated as precious. You would not swing at mediocre opportunities. You would wait patiently like a crocodile resting beneath the water. You would read hundreds, even thousands of annual reports to identify a flawless opportunity. When that opportunity appears, when the odds are overwhelmingly in your favor, when the so-called fat pitch arrives, you do not place a small bet. You allocate heavily, perhaps 40%, even 50% of your net worth. Consider the billionaires admired in the United States. Bill Gates built his wealth through Microsoft. Jeff Bezos built his wealth through Amazon. Elon Musk built his wealth through Tesla. None of them became wealthy by purchasing hundreds of unrelated stocks. Vast fortunes are created through radical concentration and only later preserved through diversification when necessary. This approach presents the greatest psychological challenge for most investors. Can you tolerate long periods of inactivity and boredom waiting for a decisive moment? Most people suffer from action bias, the tendency to prefer doing something rather than nothing. They feel that if they are not trading, they are wasting time or missing opportunities. Under this rule, frequent trading is not only costly through transaction fees, capital gains taxes, and bid-ask spreads, it is destructive because it disrupts the rhythm of compounding. Wealth is not created through constant buying and selling. Wealth is created by waiting for the right moment. What is required to succeed in this way? A punch card with 20 precious holes and one beautiful home run, a concentrated investment thoroughly researched, executed when the probabilities clearly favor you. This is how the composite man accumulates positions. He does not scatter capital. He waits, then acts decisively when opportunity is clear. This rule is not designed for those who enjoy feeling busy or who seek comfort through diversification. It is designed for those willing to remain patient, willing to say no to hundreds of good opportunities in order to wait for one exceptional opportunity. When you reach that level of discipline, you are no longer a retail participant chasing the market. You begin to operate in alignment with those who truly move it. The third rule does not relate directly to money or to the technical skill of reading the tape. It concerns your character and psychological strength. Without this rule, you would not survive 10 minutes in the stock market, especially in an era where every decision is exposed to public scrutiny. We call it the inner scorecard. In the age of social media, where most American investors now live mentally and emotionally, people are pulled into a massive external scorecard system. You buy a luxury car so your neighbors will feel envy. You travel in order to post photographs on Instagram and collect hundreds of likes. Personal value is measured by likes, comments, and followers. All of it is crowd approval. That approach may function in daily life. In investing, especially in contrarian investing aligned with the Wyckoff method, it becomes financial suicide. To become a truly successful investor, someone who can stand against the crowd and still generate sustainable profits, you must develop psychological isolation. You must be able to stand on the opposite side of the entire market. Here people call you irrational, outdated, or foolish and still sleep peacefully at night. Without this isolation, you will be swept away by noise, the noise from Wall Street, from social media, from friends, and you will eventually make poor decisions simply to avoid feeling alone. Recall the dot-com bubble mentioned earlier. At the end of the 1990s, if I had cared about what Wall Street thought of me, if I had feared being labeled a dinosaur who did not understand new technology, I would have purchased internet stocks and gone bankrupt when the bubble collapsed in the year 2000. I did not care. I had an inner scorecard. I knew my actions were correct based on fundamental principles, and truth does not change because a crowd votes against it. I often present a harsh psychological test. Would you rather be the best lover in the world while everyone believes you are the worst, or be the worst while everyone believes you are the best? If you choose reputation and external validation over reality, you will never master the dark code. On the path to substantial wealth accumulation, you will repeatedly face moments where you must choose between appearing foolish but being correct or appearing intelligent while being wrong. I have lived in the same house in Omaha for more than 60 years. I drive a normal car. I eat McDonald's and drink Coca-Cola. Many people look at that and ask why someone wealthy would not display more luxury. They misunderstand the principle. I do not need to spend money to prove my identity to anyone. Image, or what many people call saving face, is the most expensive liability on a personal balance sheet. Millions of middle-class Americans face financial distress not because they invest poorly, but because they attempt to maintain an external image they cannot afford. They borrow money to purchase luxury cars, large houses, and expensive vacations only to impress people who are not truly concerned about them. Real billionaires do not focus on image. We focus on economic moats and durable cash flow. When you shift your attention from external approval to internal standards, When you no longer require an audience to validate your decisions, you gain a genuine superpower: independence. Only when you do not need applause can you perform the contrarian investment strategy effectively. That is how victories occur quietly while the crowd continues arguing loudly on social media. This rule appears simple. In reality, it forms the psychological foundation for every other rule. If you are still controlled by the opinions of others, by fear of criticism, or by the need for recognition, then even perfect application of inversion or radical concentration will fail under market pressure. Ask yourself who is scoring your performance. If the answer is yourself, then you are prepared to move forward where patience becomes the most powerful strategic weapon in the game. The fourth rule. If the previous rule teaches us how to remain psychologically stable in front of the crowd, this rule teaches us how to transform patience into the most powerful weapon in the market. We call it the art of doing nothing. It sounds completely contrary to modern American investment culture. In reality, it is the advantage that major operators use to outperform the rest. In today's society, especially in the United States, being busy is worn like a badge of honor. When you ask someone how they are doing, they often respond with pride, saying they are overwhelmed with work. In the public rule set, busyness equals productivity, and action equals results. In the dark code aligned with Wyckoff, busyness is often a sign of mental laziness. It reflects an unwillingness to think deeply, to wait for the right moment, and to filter out what is irrelevant. If you entered my office in Omaha, you would be surprised by the near total silence. There are no flashing Bloomberg screens. There are no traders shouting orders. There is not even a computer on the desk. I spend most of my time doing only two things. I sit and I read. Some people have described my investment style as lazy to the point of idleness. They are correct. But this laziness is deliberate, and it is more powerful than constant activity. Blaise Pascal once observed that many of humanity's problems arise from the inability to sit quietly alone in a room. Traders on Wall Street often suffer from action bias, the tendency to act simply for the sake of acting. If a stock rises, they feel compelled to sell and lock in gains. If it falls, they feel compelled to buy and attempt to catch the bottom. They behave like fish that bite at every piece of bait without discrimination. This frantic activity creates enormous friction costs, including transaction fees, short-term capital gains, taxes, and bid-ask spreads. More importantly, it disrupts the rhythm of compounding, which Albert Einstein described as the eighth wonder of the world. You must understand a central principle. Wealth is not created through constant buying and selling. Wealth is created through waiting. When you plant a tree, you do not dig it up every day to check whether the roots are growing. You leave it in place, water it properly, and allow it to grow. Our work is similar. It is not about constant action. It is about filtering information. I read approximately 500 pages of material each day: annual reports, quarterly reports, industry documents, and business books. I absorb information and construct mental models. In the process, 99% of the time, my conclusion is to do nothing. This is deliberate inactivity. We wait until the barrier to action becomes low enough, until the decision is so clear that it does not require brilliance to execute. Imagine a crocodile resting beside a river. It can remain motionless for weeks, even allowing insects to land on its nose without reacting. From a distance, it appears to be a stone. When prey approaches within range, the attack is fast, powerful, and decisive. The quieter you are during periods of calm, the more energy you conserve. When opportunity arrives, when the true fat pitch appears, you can act with intensity and precision. In contrast, if you waste energy on small daily trades and mediocre opportunities simply to feel productive, then when the truly significant opportunity arrives, you will be exhausted. Worse still, you may have exhausted your capital. No remaining funds, no psychological strength, no ability to place a substantial allocation when the probabilities clearly favor you. This rule is particularly difficult for American investors because the culture celebrates action, speed, and hustle. In the stock market, excessive action is often the enemy of long-term returns. The art of doing nothing requires extreme discipline. You must tolerate boredom, resist fear of missing out, and trust that the largest rewards come from waiting for the correct moment. When you master this rule, you are no longer a victim of the market. You become a patient predator aligned with the composite man. That foundation prepares you for the next rule, where the ability to say no with ruthless clarity becomes the pathway to what truly matters. The fifth rule. If the previous rule teaches us how to turn patience into strength, This rule elevates ruthlessness to a new level and applies it to your own life and career. We call it ruthless subtraction. It is perhaps the most demanding rule in terms of time management, energy allocation, and life direction. It is also one of the most powerful rules for achieving exceptional results. Most people, especially in the United States where hustle culture and multitasking are celebrated, believe that success comes from addition. Add more projects, add more relationships, add more skills, add more opportunities. They attempt to pursue everything afraid of missing out. In the logic of high performers, true success does not depend on how many things you do. It depends on how many things you refuse. Let me share a real example involving my personal pilot, Mike Flint. He worked for me for more than 10 years. One day, Mike told me he felt his career was stagnating and not progressing as he hoped. I gave him a simple exercise. I said, Mike, write down the 25 most important goals in your career. He took time to think and listed 25 goals. I then said, now, circle the 5 most important ones, the goals that would truly transform your life if achieved. That step was more difficult than he expected. After careful reflection, he selected 5 core objectives. He now had 2 lists. List A contained the top 5 goals. List B contained the remaining 20. Mike looked at me and said, I understand. I will focus most of my energy on List A. In my spare time or when I have extra capacity, I will gradually work on List B since those are also things I want to accomplish. I told him he was completely mistaken. The remaining 20 goals are not a secondary task list. They are an avoid at all costs list. Until you complete the top 5 goals, you must not devote a single minute to the other 20. You should not even allow your eyes to drift toward them. Why such severity? Because this is the precise reason most hardworking people fail. What destroys you is not obviously bad ideas or unethical actions. Those are easy to reject. What truly undermines your potential are good ideas. Opportunities that are good but not exceptional. The remaining 20 goals represent those moderately attractive opportunities. They offer some progress, some return, some satisfaction. Yet they absorb your time and energy like leeches. They guarantee that you will never reach world-class performance in the 5 areas that truly matter. Real focus requires eliminating things you enjoy. It requires killing alternative paths that are interesting and promising. This sounds harsh. In a world of finite resources where time is limited to 24 hours per day, energy is limited, and capital is limited, this is the only way to achieve substantial success. If you chase 2 rabbits, you will catch neither. Under this rule, we do not even recommend chasing 1 rabbit. We recommend staring at the rabbit hole until the rabbit emerges, meaning you wait for an opportunity so clear that it cannot be ignored. Peak achievement does not depend on the number of activities you pursue. It depends on the number of activities you decline for the sake of the right objective. The most successful individuals in the United States, from technology billionaires to legendary investors, are masters of saying no. They reject hundreds of good opportunities each year in order to preserve resources for a few exceptional ones. They eliminate side projects, relationships that do not create significant value, and skills that do not serve the core mission. All of this is done to concentrate resources on what truly creates impact. This rule of ruthless subtraction connects directly to the art of doing nothing. You do not merely wait for a favorable opportunity in the market. You remove everything else in your life that competes for mental space and time so that when the decisive moment arrives, you are fully prepared. It is disciplined severity applied to yourself for long-term benefit. When you master it, you stop chasing the market. You begin shaping your own path aligned with the behavior of major operators. That foundation prepares you for the next rule, where reputation becomes the most powerful economic lever you can possess. The 6th rule. If the previous rule teaches us how to eliminate what is unnecessary in order to focus on what matters most, this rule elevates the game to another level. It transforms personal character into the most powerful economic leverage you can possess. We call it reputation as the ultimate leverage. This rule is rarely discussed openly in investment circles because it sounds more like a moral lecture than a financial strategy. Within the dark code aligned with the Wyckoff philosophy, we do not treat it as a moral issue. We treat it as the most efficient form of economic leverage, one that creates an unmatched competitive advantage. There is a well-known statement that most American investors recognize. It takes 20 years to build a reputation and 5 minutes to destroy it. If you reflect carefully on that idea, you will approach every business and investment decision differently. To the public, business can appear to be a game in which people are willing to sacrifice principles for an additional 10% return. Among those who achieve exceptional success, the logic is reversed. As long as I do not lose my reputation, I can lose money and still recover. Why is that true? At the highest level of the business game, where the composite man truly operates, efficiency is measured by the lowest possible friction. If you and I must draft a contract of thousands of pages, hire 50 lawyers, and spend 3 months conducting due diligence simply to prevent the possibility of deceiving one another, then before earning a single dollar, we have already consumed enormous transaction costs. That friction in time, capital, and mental energy is the greatest enemy of long-term profitability. At Berkshire Hathaway, we have often completed multi-billion-dollar acquisitions with a handshake, in some cases without a detailed formal contract. How is that possible? Because the counterparty knows that the word of Warren Buffett is reliable. I also know that the other party is trustworthy. That mutual trust allows transactions to move with extraordinary speed. While others are still reviewing legal clauses, we have already written the check and closed the deal. This is reputation leverage. When you are known for integrity, the resistance in your business operations approaches zero. Opportunities begin to seek you out. Business owners and major investors prefer to transact with individuals who will not betray them. In a world filled with opportunism and deception, honesty becomes a scarce resource. According to the basic law of supply and demand, scarce resources command the highest value. Consider the context of modern American investing. Many retail investors chase quick trades, fashionable stocks, and promises of rapid wealth without regard for long-term credibility. Large-scale operators, those who generate billions in capital, treat reputation as an intangible asset more valuable than any single investment. They are willing to sacrifice short-term profit to protect credibility because they understand that a strong reputation opens doors that money alone cannot open. This rule connects directly with every prior principle. You may practice inversion, radical concentration, psychological independence, patience, and ruthless subtraction. If your reputation is compromised, the structure collapses. Conversely, when you build and protect reputation as a strategic asset, you not only reduce transactional friction, you create a system in which opportunities approach you rather than the reverse. In the world of the composite man, integrity is not merely an ethical preference. It is a disciplined and rational business strategy. When you master this form of leverage, you are prepared for the final rule where you define your true position within the market ecosystem and ensure that you are never the prey. The seventh rule and the final rule is the ultimate intelligence required to survive and achieve long-term success in the casino known as the stock market. We call it, know who the sucker is. This is a survival principle that every American investor must internalize if they wish to avoid becoming a victim of the very ecosystem in which they participate. There is a classic rule in Las Vegas casinos that applies perfectly to financial markets. If you have been at the table for 30 minutes and still do not know who the sucker is, then the sucker is you. Many individuals go bankrupt not because they are lazy or uneducated, but because they misjudge their position within this ruthless ecosystem. They believe they are the hunter. In reality, they are the prey. You must be radically honest with yourself. Where is your genuine competitive advantage? What are the boundaries of your circle of competence? This is the question most retail investors in the United States avoid because it forces them to confront their limitations. Popular culture encourages you to step outside your comfort zone, challenge yourself, and learn new domains. That sounds inspirational. In the darker strategic code, the message is more direct. Do not be foolish. Stay within your circle of competence and never step beyond it. I have spent my entire life avoiding industries that I do not understand. For example, I do not understand semiconductor engineering or advanced chip design. I do not understand cryptocurrency or digital assets. Although my close friend Bill Gates leads one of the largest technology companies in the world, I have never invested in high-growth technology equities or digital tokens. Why? Because in those arenas I would be the sucker. I have no competitive advantage. If I entered those markets with my capital, younger experts with deep technical knowledge and fluency in software code would outperform me within months. Admitting ignorance is not weakness. It is a higher form of intelligence. You do not need to understand hundreds of industries in order to build wealth. You need to understand a few areas deeply, truly deeply, and apply disciplined action over a long period of time. Your circle of competence may be small. As long as you remain inside it, you are difficult to defeat within that domain. That is where your real advantage exists: accumulated experience, specialized knowledge, and the ability to interpret price and volume behavior with clarity. When neighbors or friends generate substantial profits from cryptocurrency speculation, meme stocks, or fashionable trends that you do not understand, the common reaction is envy followed by imitation. Investors fear missing out. They fear being left behind. The disciplined operator simply responds, "I am pleased for them, but I do not understand that asset class, so I will not participate." That is not arrogance. It is discipline. If you do not know who is on the other side of your trade, and if you cannot clearly explain why you possess an advantage in that transaction, then you are not investing. You are gambling. In the market casino, the house, meaning the composite man and large institutional operators, wins over time. They profit from the ignorance and emotional behavior of the crowd. Therefore, define your circle of competence today. It does not need to be large. It must be clear, and you must remain firmly inside it. Outside the circle lies the danger zone. That is where you become the sucker. That is where you provide liquidity to more informed participants. That is where you are easily manipulated by noise and short-term trends. Inside the circle is where you hold an advantage. That is where you interpret price action accurately. That is where you wait patiently for a high probability opportunity and allocate capital decisively when it appears. This final rule summarizes the entire journey. Avoid foolishness through inversion. Apply extreme focus to what you truly understand. Maintain an internal scorecard. Exercise patience and refrain from unnecessary action. Practice uncompromising elimination. Build reputation as economic leverage. All of it leads to one conclusion: know who you are in this game. When you understand your position, you are no longer a victim. You become a rational participant who can survive and achieve substantial success within the ecosystem dominated by the composite man. These are the 7 rules. They mark the final destination of the journey we have taken together. Let us review them once more so they are firmly embedded in your mind. Rule 1. Inversion. Avoid ruin first. Preserve capital by eliminating areas of irreversible risk. Rule 2. The art of extreme concentration. Operate like the composite man during accumulation. Allocate substantial capital to exceptional opportunities. Rule 3. The internal scorecard. Maintain psychological independence. Live according to objective truth, not according to public approval. Rule 4. The art of doing nothing. Practice active patience. Wait for the fat pitch instead of engaging in constant trading activity. Rule 5. Ruthless subtraction. Say no to most opportunities in order to preserve time, capital, and energy for what matters most. Rule 6. Reputation leverage. Build credibility as your most powerful economic asset. Reduce transaction friction to near zero. Rule 7. Know who the sucker is. Remain within your circle of competence. Understand your position clearly so that you do not become the prey. They sound simple. They do not require extraordinary intelligence or complex financial engineering. Yet, among 100 American investors who study these principles, perhaps only one will apply them consistently over many years. Why? Because they contradict deeply rooted human instincts. The instinct to conform to the crowd. The instinct to seek validation and applause. The instinct to remain busy in order to feel productive. The instinct to pursue rapid wealth without enduring the discipline of time. This strategic framework demands acceptance of solitude. It demands indifference to social media noise and public opinion. It requires patience that can appear almost emotionless. At times, it requires the willingness to look temporarily foolish in the eyes of others. This is the path chosen by few. It resembles the first-class cabin on an aircraft. The seats remain available because most people choose the crowded economy section where noise and competition are constant. This message is not intended as entertainment to be consumed and forgotten. It is intended as a starting point for structural change. Therefore, consider a personal commitment. Identify one outdated rule you will eliminate, or one new rule you will implement starting today. For example, you may decide that you will no longer incur debt to finance appearances or lifestyle inflation. You may commit to allocating capital only within your defined circle of competence. You may choose to act like a patient predator waiting for high probability setups instead of trading continuously. This is not a promise to any external audience. It is a contract with your future self. One day, whether in 10 years or sooner, when you recognize that you have advanced beyond your previous financial class, you will understand that the transformation was not only reflected in your brokerage account balance, it altered the trajectory of your family across generations. That is the true reward of disciplined investing under this framework. The market is open, you hold capital. Allocate it with discipline. Do not operate as a victim of volatility and crowd psychology. Operate like the composite man, patient, focused, fully aware of your position within the game. Thank you for engaging in this journey. The next decision belongs to you.